A structural shift has already begun, and the evidence is not dramatic, public, or debated. It arrived quietly, embedded in custody reports, exposure tables, and rebalancing flows that never reach headlines. What changed was not sentiment or narrative, but positioning. Capital that had been anchored for years to a familiar center began to loosen, then move, then settle elsewhere. Not in a rush, not in panic, with intention. For more than a decade, global markets operated under a stable assumption. Growth, liquidity, and safety were concentrated. Risk assets rose together. The dollar sat at the center of pricing, and diversification often meant little more than cosmetic variation. That assumption is now failing in real time, not because of a single crisis, but because the constraints that supported it are tightening simultaneously. When the largest asset manager in the world adjusts exposure measured in trillions rather than billions, it is not a reaction to headlines. It is a response to pressure that has already crossed a threshold. These moves do not announce themselves. They appear only after the fact, when secondary effects begin to surface in places that seem unrelated. Currency behavior starts to drift. Regional equity performance decouples. Capital costs diverge. None of this looks like an emergency. That is precisely why it matters. For years, capital allocation was rewarded for staying close to home. Depth, liquidity, and policy support made concentration appear rational. The feedback loop reinforced itself. Strong markets attracted more capital, which made them stronger still. But feedback loops do not persist indefinitely. They reverse when marginal returns compress and alternative paths begin offering better energy transfer. Finance obeys this rule as reliably as physics. What is unfolding now is not a withdrawal, it is a rotation. Exposure is being redistributed across jurisdictions where demographics, valuation, currency positioning, and productive capacity align more favorably with the next phase of the cycle. This is not about abandoning one market for another. It is about adjusting the center of gravity. The most important detail is not the destination, but the timing. These reallocations began before consensus acknowledged any need for them. They accelerated while public discourse remained focused elsewhere, and they are still ongoing because structural shifts do not complete themselves in a single quarter. The visible consequences are subtle but accumulating. Markets that once moved in lockstep now diverge. Assets long dismissed as stagnant begin outperforming. Currency effects re-enter the return equation after years of dormancy. None of this requires belief, it only requires observation. What appears calm on the surface is already under tension beneath it, and the forces driving this rebalancing have not yet fully expressed themselves. That comes next. At a certain scale, choice disappears. Capital above a certain size cannot chase narratives, trade momentum, or rely on optionality. It must obey constraints. Liquidity depth, political durability, demographic throughput, and currency stability stop being abstract considerations and become binding conditions. This is the world large institutions operate in, and it is why their movements reveal more than their words. Managing exposure measured in trillions requires thinking in terms of systems rather than assets. A marginal improvement in return, compounded across a base of that size, reshapes outcomes. Conversely, a small structural misalignment left uncorrected becomes unacceptable risk. This is why reallocations at this level are slow, deliberate, and decisive. For years, the dominant system offered an unusual combination: high liquidity, strong asset performance, and a reserve currency that amplified returns. That combination is now eroding, not collapsing, but normalizing. As it does, capital must reprice its assumptions. Valuations matter again, currency differentials matter again, growth differentials matter again. When those factors reassert themselves, capital begins to seek environments where real expansion is still occurring, rather than being sustained by leverage and policy support. This is not ideological, it is mechanical. Young populations consume, build, and work. older populations preserve, draw down, and stabilize. These realities show up in productivity curves long before they show up in politics. At the same time, currency dynamics are shifting from a one-way trade into a two-sided market. When a dominant currency weakens modestly over time, it does not trigger alarm, it changes math. Returns earned elsewhere translate back more favorably. Risk-adjusted outcomes improve without requiring higher nominal performance. For large portfolios, this is decisive. None of this suggests imminent failure of any single market. It suggests redistribution of marginal capital. That is how global systems adapt without crisis. Pressure moves first at the edges, then gradually reshapes the center. The key misunderstanding among smaller participants is assuming that large institutions wait for clarity. They do not. Clarity is a byproduct of positioning, not a prerequisite. Institutions act when probability distributions tilt, not when outcomes are guaranteed. By the time certainty is visible, capacity has already been allocated. This is why the most important signals are not announcements or forecasts, but flow. Where exposure is increasing quietly, where it is being reduced without drama, where capital is accepting temporary volatility in exchange for structural alignment. Those flows are now visible to anyone willing to look past headlines and into the mechanics of the system, and as they continue, their secondary effects will grow harder to ignore. The next layer of this shift is already showing up in performance. When a system transitions, correlation breaks before narratives do. Assets that once rose together begin to separate. Regions that were assumed to be peripheral begin outperforming the core. This is not random, it is how markets express changing constraints. Over the past cycle, returns were dominated by a narrow set of markets and sectors. That concentration was efficient while conditions supported it. As those conditions fade, dispersion returns, not evenly, but directionally. Capital flows toward environments where incremental growth is still cheap, labor is still expanding, and balance sheets are less saturated. Recent performance across international markets reflects this process, not as a spike, but as sustained relative strength. These gains are not driven by speculation, they are driven by valuation normalization combined with real economic throughput. When starting prices are lower and growth rates higher, the math becomes difficult to ignore. Currency effects amplify this divergence. When investments are made in jurisdictions where the local currency is undervalued relative to productive output, appreciation becomes a return component rather than a risk. This was absent for years. It is now returning quietly. The result is a dual channel of performance: asset appreciation and currency translation. Both require no extraordinary growth, both require alignment. This is why large portfolios are repositioning incrementally rather than dramatically. They are allowing compounding to do the work. Volatility remains higher in many of these markets. That is expected. Volatility is not risk at long horizons when it is paired with structural growth. It is only risk when leverage and timing are mismatched. Institutions with patient capital can absorb interim fluctuations in exchange for long-term rebalancing. The narrative lag is important. Public discourse still frames many international markets through outdated assumptions: stagnation, instability, inefficiency. These descriptions persist long after conditions change. Capital does not wait for narratives to update. What matters is not whether every country succeeds equally. Large portfolios do not require that. They require that aggregate growth outpaces alternatives. Breadth replaces precision. Exposure replaces prediction. This is where diversified international allocation becomes a tool rather than a thesis. It allows participation in systemic growth without requiring perfect selection. That is attractive when the alternative is paying premium valuations for mature systems with tightening constraints. It is important to state clearly that this analysis describes observed behavior, not instruction. Positioning outcomes discussed here reflect institutional flows and structural logic, not financial advice. Individual circumstances vary, and risk tolerance matters. What cannot be ignored is that divergence has returned, and once divergence takes hold, it tends to persist until constraints realign. The next piece of this puzzle lies not in equities, but in the foundation of the financial system itself. While capital reallocates across markets, a deeper adjustment is occurring beneath them. The definition of liquidity itself is being revised. Assets once treated as inert are being reintegrated into the core architecture of finance. This is not a cultural shift, it is regulatory and mechanical. Recent banking frameworks have altered how certain hard assets are classified on balance sheets. Physical reserves that were previously discounted or sidelined are now being recognized as high-quality liquid assets.